have a close impact on commodity markets. One is the immediate impact, wherein if interest rates are reduced, home currency devaluates against the dollar. Say for example, so whenever this happens, currency markets will get a hit, and in turn we'll get an opposite movement in the commodity side. And on a medium term range, if I talk about interest rate impacts, if interest rates are reduced, this is what has happened in pandemic time. When there was a pandemic, lockdown was there, many of the reserve banks of different nations, they've started reducing their interest rates or starting with a money easing policy, whereby they want money to be flowing in the economy so that people, they start demanding and spending more. And only when demand and spending increases, the manufacturing sector will also pick up and other things will start reviving and economies will work. So if this concept is happening, then in a medium term, with reduction of interest rates, inflation will pick up, and inflation always picks up on the commodity prices, so commodity prices will go up. So it's hand in hand. So interest rates have an impact via currency on commodities and through inflation on commodity prices. And definitely capital market, if we talk about a lot of infusion in equity market is coming from FIIs, and if sometimes we say a lot of drawdown is happening, markets are falling, that is FIIs are taking their money back. So generally what they do is they bring in their money in foreign currency, convert it into rupee and invest in markets. So when this happens, rupee is in demand, again currency prices move, and we have some valuation changes in commodity prices. And one, this drawdown happens when people are selling rupee and buying their currencies and going taking away their money. Again, that impact is slightly seen. Plus, even equity market companies who are linked with commodities, they get a hit when commodity prices become volatile and unmanageable for them. So it goes hand in hand. A clear-cut example of commodity being considered as an important asset class is during this first pandemic, when most of the markets were not performing well and they were practically not working. So equity markets, currencies, and debt market, wherein a lot of investments were placed, they were giving negative returns. So it was a kind of a crisis situation wherein other markets were not performing well. So what big hedge funds, portfolio managers, and mutual funds across the globe they did was they started investing into commodity derivatives, and particularly in gold and silver. So during this phase, if we go back and see the prices from say in August 2020, since gold has started been trading in in money terms, since then in 2020, gold and silver have reached or seen the all-time high prices. It is not that in pandemic people have started using or buying gold or silver. It is that worldwide, since this asset class is available to all the market participants, so they hedged their risk by increasing more weightages to commodities in a crisis situation. That is where through portfolio management concept, commodity as an asset class becomes very, very important for the investment and trading community. So what is there in this asset class? We generally, there are 6 commodity exchanges in the world, wherein these are the 4 main segments in which commodities are traded, derivatives are traded. Maybe one is agricultural commodity, wherein all agriculture produce spices, pulses, plantation crops, and other products wherein we can have derivatives are clubbed. Base metals include metals which are in high demand and in usage in many sectors of the economy. That is aluminum, copper, lead, nickel, zinc. They form a group under base metals. Energy product includes crude oil, natural gas, coal, and other variations like naphtha, LLDP, and somewhere you will find in some exchanges even aviation turbine fuel is also traded. Bullion segment includes gold, silver, platinum, palladium, diamond on some of the exchanges which are there. And apart from these traditional 4 segments of commodities, an emerging segment is also coming, for 2 years now, which is intangibles. So even we will find weather derivatives and climatic contracts in some of the exchanges in the world. Exchanges like Chicago Climatic Exchange, Tokyo Climatic Exchange, in weather derivatives are also traded. Weather derivative becomes very important for some of the sectors of the economies, maybe agricultural or other sectors, wherein people would like to hedge that risk of unforeseeable weather in advance. We have also freight derivatives which are traded. Freight is the money you pay for transporting your products from one place to the other place. So, when we talk about importing and exporting any products changing hands. So these vehicles on which, or I would say, the ships on which products are traded becomes very important. So people, they use freight derivatives to manage this kind of space, risk, and expensiveness well in advance. This is a cost. Even electricity is also a product on which, we have spot markets where electricity is also traded. We have one of the exchanges in India as well, wherein electricity is traded in physical, that is Indian Energy Exchange. So, for your information, derivatives on electricity will very soon be introduced on MCX. We are in talks with the regulator, which is SEBI. So very soon you will find, even on intangibles, lot many products are being introduced. And for your knowledge, even water as a product has been introduced in form of derivatives on one of the exchanges in the world, which is CME. So this is how commodity markets have been evolving, with intangibles also coming in, and from time and again, more products are coming in. On many exchanges across the world, you'll be able to find even live cattle, pork bellies, and other things are also traded. Um, so the story stands. Generally, what raw commodity is they are product. Around 92 to 93% of the economic sector of the world, they are commodity intensive. You talk about apparel industry, you talk about food and food processing, FMCG, electronics and electricals, computer based, or you talk about food industry in a big way, or you talk about automobile industry, construction sector. They're all commodity linked industries. So price variation in these products which are used in all these industry cause a lot of distress for companies who are into the business. So they use commodity derivatives to manage these kinds of risk. So commodities are generally raw materials which are used to create livelihood in different ways. If they are processed, again reprocessed, and different kinds of finished products could be made out of them. Commodity in derivatives are taken in their basic form, which are fungible and homogeneous across borders in all the markets. Agricultural products are called as soft commodities because they could be produced and reproduced again and again, whereas base metals, energy, and bullion are hard commodities because they cannot be added on by any human effort. They have to be taken out from the earth crust by a process called as mining or refining and other things, which are limited in resource. So overall, commodity valuations, the prices of products, they are largely impacted by many fundamental factors, which I was just talking: macroeconomics, microeconomics factors, changes happening across the world, availability of product, demand variations over different seasons, in a year. Plus, these commodity prices, they also get impacted by cross asset, interest rates, and currency also impact. Plus, these prices, they have some special factors also. Weather becomes an important factor when we talk about agricultural product. Crisis situation and insecurity in the market becomes an important factor for bullion side of commodities. Like there are many special factors also attached with all these products. In Indian market scenario, since we already have a big physical market, so derivative market require a proper regulation wherein financial derivatives are traded. So since we started in 2003 till 2015, Forward Market Commission was the regulator, which eventually got merged with SEBI, Securities and Exchange Board of India, in 2015. So from September 28, 2015, SEBI is the common regulator for commodity derivatives, currency derivatives, and equity derivatives. Below them is all the stock exchanges who abide by the regulations laid down by the regulator, and all exchanges, they have their own rules and bylaws under which authorized members, that is SEBI registered members, are allowed to operate, and everybody cannot be a member. So only SEBI registered members are allowed to operate in these exchanges, and we as normal citizens can be clients to these authorized members and take part in these exchange traded markets. So since 2003, we started with futures, and all physical players allowed to hedge their risk, as well as market participants who take risk like speculators, fundamental traders, technical traders, jobbers, arbitrage. They were allowed to be in the market. But since then, but till 2017, it was only futures. In 2017, we have been allowed to have options also as a derivative on the exchange. In this meantime, what has happened is market intermediaries have got integrated. That means we need to have just only one KYC with one registered member, and we can trade in any of the asset segments. Now, because of that, even we have moved to a concept called as universal exchanges, wherein a single exchange can have any of the asset classes. So that is where you would find even NSE or BSE, which are equity exchanges. They also have currency asset. They also have commodity contracts also tradable. Um, Now, during all these years, 18 years of MCX into place, we have seen, introduction of new products like options and introduction of new market participants, by which we could say market is still developing and not fully developed. Now we have allowed, SEBI has allowed bank subsidiaries like Kotak Securities or Axis Securities to participate in commodity as well. Then they've also allowed eligible foreign entities who are FDIs, have operations in India, to come and manage risk on the exchange. SEBI and then subsequently allowed category 3 alternate investment funds, which are called as hedge funds, to be part of the market. Then they have also allowed 3 years back mutual funds and portfolio management services to also be part of commodity derivatives in India. What not is allowed as of now is FIIs and banks. So since commodity is a global product, once these FIIs and banks will be allowed, it will take markets to a different revolutionary level. So before that, markets have to develop more product wise and I would say participation wise. So after options, we have recently introduced, in 2020, a new segment also, which is index trading in commodities. So since commodity have some segments, so we have segmental Boolean index derivatives were allowed in 2020. Then in again October 2020, metal index futures were allowed. Last year, October 2021, energy index futures were allowed. So slowly and slowly, from product side, market is developing, and from market participants wise, market is also developing. So once we have all participation and product, this market will become very important. It will be a time when Indian exchanges will be price setters for international commodity trade and exchanges all across the world, giving our population base. So what do we trade on a commodity exchange? We usually have commodity contracts here. Now, these contracts are standardized futures and options. Now, why do we require these contracts when we have physical commodity market in a big way? The answer is, as rightly mentioned by Dr. David, uh, because commodity contracts and derivatives are available, it helps in something called as price discovery. Now, what is price discovery? People in market, once they are connected on a single platform, they discover the prices on their own, which are the true reflective of the market. And once everybody gets connected to an online market, these prices could be used as reference and base price for physical trades and for any kind of trading across the world. So one is price discovery, which is price discovered by market participants, and second is to manage risk. Who does that risk management? Anyone and everyone who deal with the product, starting from farmer to processors to ginners to different value additioners in the product line. So they can all come and manage their risk. So what the in a basic form, what the market size look like is, we have spot markets or mandis, or wherein physical trading of product happens, wherein buying and selling of product happens with paying of money upfront. Along with that, we have derivative market or exchanges whereby buying and selling of financial instrument happens, who get their value from the products of the spot market only, right? So when these two market coexist, it gives advantage to the physical players to manage their risk using these derivatives, who get their value from the underlying physical product. So what is a derivative? Somebody will ask. Derivative is nothing but a financial instrument who gets its value from the underlying asset. So if I say it is a gold derivative, so it is getting its value from the underlying gold in the physical market. So if it is a cotton derivative, it gets its value from the underlying cotton product in the market. So if it is a crude palm oil, it gets its value from the crude palm oil in the physical market. So, this is how derivatives are. Generally, derivatives are of four types: forwards, futures, options, and swaps. Right. So I'm not going to go into, explaining what a derivative is. This is enough. We all know, it is a financial instrument wherein it gets its value from the underlying assets. Now, the important point is the derivative on the exchanges are standardized derivatives, that is only futures and options, wherein exchange defines the trading terms and delivery terms, approved and vetted by the regulator, and then these contracts are made available for people at large to come and manage risk and trade depending on what is their motive. Now, when you trade derivatives on the exchange, it gives two advantages. One is product are standardized. Second, you can enter and exit at any point in time. And third is market is transparent. Everybody gets the same information, same prices at any given point in time. So that is an advantage, and very important point when we trade with exchange, that counterparty default risk of derivatives when they are dealt one to one with each other goes away. On the exchange clearing house doesn't allow that counterparty default risk to even be there. So overall, we have all kinds of market participants allowed as of now on domestic exchanges. Okay. Plus, since commodity is a global product, we have a elongated trading hours on exchange. Commodity derivatives are traded from 9 o'clock in the morning till 11:30 in summers and 11:55 in winters. Out of that, agricultural commodities with local reference like cardamom or few spices, wherein prices are referred to locally, they trade from 9 to 5. Agricultural product like cotton, crude palm oil, mentha oil, they are international referenceable products. So in them, trading is allowed from 9 o'clock in the morning till 9 in the evening in summers and 9:30 in winters. And segments like bullion, metals, and energy, which totally have international price reference, trading in them is allowed from 9 in the morning till 11:30 in the night in summers and 11:55 in winters. So we have an elongated working hours. So this is how typically a trading screen looks when trade happens. So what I do is I just stop my session here in presentation, and I'll take you to the live trading which is happening on the exchange right now. So this is a screen which is an MCX trading screen which I'm just sharing right now. So more than maybe 10 million people are connected right away. They are all across the India connected to this screen, and this could be any value chain partner or traders. So everyone is getting the same price in front of them, and buyers are giving their buy bid, sellers are giving their sales bid, and once a buyer agrees to the sales bid or a seller agrees to the buying bid, a trade happens. Now, whenever a trade happens, this LTP gets generated. What is this LTP? Is the last traded price. Okay. So whenever a trade happens, say the market prices are discovered by market participants. See, buyers are giving their bids, sellers are giving their bids. Moment anyone agrees to the other person, a trade happens, and this trade LTP becomes a unique price discovered by market participant as the single price till the time new trade happens. So this is how, using exchange derivative, market determined single price across India. So if you go to a jeweler or ask him, boss, what is the today's price? He will look at the MCX screen, take the price there and give you a price. It means he's also referring to the exchange market, which is connecting everyone in India. So these are all derivatives. Look at the screen. So this first segment is available. This is gold and silver, which is displayed here. I'm scrolling it down. So we have base metals as well, aluminum, copper, lead, nickel, zinc derivatives are there. If I slightly go down, we have energy derivatives, crude oil and natural gas. And if I go down further, we have agri products also, cotton, crude palm oil, kapas, menthol oil, and rubber, which are available to trade. And all are trading live. These are live prices, which is happening. So how do I get to know what kind of derivative it is? So if we see the first column, it is saying futures, FUTCOM. It means all derivatives which are there on the screens are futures contract getting its value from the physical commodity. Next column is the underlying asset. You just see. So if it is futures on a commodity, underlying asset is gold. If it is a futures on commodity, underlying asset is silver. Likewise, if it is futures on aluminum, copper, futures on crude oil, futures on cotton, kapas, menthol, like this. Okay. Now, sometimes in some products, what happens, we have different contract sizes also. Say, for example, gold, we have 4 kind of derivatives. We have gold 1 kg contract, which is symbolized as gold. We have a gold 100-gram contract, which is symbolized as gold mini. We have a 8-gram contract, which is as gold mini. We have 1-gram contract, which is called as gold petal. Why I'm telling you this is, if we happen to be in this market, we have to choose the right derivative to manage risk or trade. And to do that, we need to know how many variations of a products are available on an exchange so that I pick the right product for my strategy. Okay. Now, All these products are linked in INR. There are some exchanges in the world wherein you can have trading in different currencies. But on exchange in India, we have everything in INR. Then the price quote becomes very important. This column. All these derivatives have an expiry date. Since these are instruments, they will expire. Now there is something called as price quote. So even if this is a 1 kg gold contract, prices are which are coming here on the screen is coming as per the price quote, which is rupees per 10 gram. That is important. I'll scroll down on the agri products as well. If I buy and sell in this contract, even though it is rupees per 10 gram, if I buy a single contract, it values for 1 kg. So it becomes 48 lakh of contract value. Similarly, if I talk about silver, it is rupees per 1 kg. So this silver is a 30 kgs contract. So quotations are coming per kg. If I go down, look at there. We have a crude oil contract. It is quotation is coming per barrel. Okay, the prices are coming per barrel, but this is contract of 100 barrel. If I talk about cotton, okay, the prices here are coming per bale. Bale we know is of 160 or 170 kgs, right? 170 kgs. But it is of some bales. The contract is not of one bale, it is of some bales, right? Crude palm oil. So this quotation, price quotation value becomes very important. It tells you that the prices which are coming on the screen are as per what value, but you have to always understand that contract size might differ from the price quoted which is on the screen. Okay, now how are these buying and selling prices coming? These are bids coming from buyers and sellers, okay, for quantity and price. So the logic behind trading on the exchange is called as the price time priority. That means whosoever gives the best price gets to trade first automatically, and there could be instances when many people would have given the best price. So in that case, whosoever has given the price first in terms of nanoseconds will get to trade first. So this is how things are done on a live market platform, wherein this is futures. Let me just introduce a product called as option here for you all to see how it looks on the exchange. So even if I just selected options here on the top, I got so many products which are available in the option to for easy of understanding. I just selected gold. There are many expiry dates for gold option contracts. So I selected the near one, 25th of March. Now there is a difference between a future and an option. Future we trade for all the market sentiments in prices, in price terms. But when we are in options, we have all the prices available. See, I have all list of prices available with me. Then I pick a price in which I want to trade. So that is where we say option is a premium game and future is a price game. What I have done is you just look at the instrument. From futures, it has changed to option, right? It is saying OPT, FUT. Now in commodity, this is a special feature. We have options on a derivative. Gold option is not having the underlying as gold. Gold option has an underlying as gold futures. Option on gold futures underlying is this. Now I am just trying to do something very important. Do you see that strike price? Now this is a price which I picked, from multiple of prices which are available. I 48,700, and on this price, look at the prices which are quoted here. They are not in thousands, they are only 600 and 700, something like that. It means in option, we have a series of prices which are available. We pick a price which is called as a strike price, and on that strike price, people they trade on premiums. Option is a premium game. So I would say 48,700 strike price, premium for selling of call option is this, and put option is this. So in option, there is something called as a call option and a put option. Call option is a right to buy, put option is a right to sell. So likewise, you could have option contracts also available. Option is preferable, over futures. Why? Because you could make many strategies using option contract because it is a non-linear derivative. Now, what I want to show you quickly is something called as index. I also mentioned index available. See, we have segmental index. We have this called as a Boolean index on the exchange. Now, the understanding was nobody trades on an index. People, they trade on index derivative. So index is taken as an underlying. So look at this instrument, futures on index. So it is a futures contract which takes underlying is Boolean index. So it is taking this Boolean index as an underlying and then trades are happening. Likewise, we have metal index representing aluminum, copper, lead, nickel, zinc. And based on this index, we have futures index. And this is where trades are happening. Similarly, we have energy index. And based on that energy index, we have futures on energy index, which is being traded. So we have overall market index, composite commodity market index is also live and ready, but it will be allowed to be traded as an underlying only when the regulator gives us the permission to do so, right? So that is again, which is something, this is where, markets are going to develop in coming years, maybe a decade or so. You will find many developments happening in the markets in terms of commodity side and instrument side. So what I do again is I go back to the presentation and start from where I have left. So when we talk about commodities, rather than front side, there is also a big infrastructure on the back side, because commodity contracts, when they are traded, they are also backed by delivery on expiry. So to deliver products, we have a lot of exchange accredited warehouses wherein big commodity traders and farmers can go and submit their products. If they are not ready to sell in the market, they can submit the products on the exchange. So you cannot just go and submit your products to the exchange accredited warehouse. A quality checking happens. So we have quality checking agencies, many of them running, this process. So they check the product which you bring in to be submitted, the quality level, moisture level, and other things. And then once the quality report is received, it is matched with the exchange specification of product, and then product is taken into the warehouse. To keep your product in warehouse, people pay storage charges, maintenance charges, fumigation, and other thing. And advantage is, once goods are stored in the warehouse, exchange accredited warehouse, e-negotiable warehouse receipts are issued, which could be traded in the warehouse receipt market. So holder can sell these warehouse receipts and take money, or they could give the receipts to the bank and take loan, because banks are also happy because goods are kept in exchange warehouses which are also quality tested. Or these people can, as and feel like they can take out their money and sell in the open market. And the fourth option what they have is they can deliver products on the exchange when commodity derivatives expire. So in commodity derivatives, on expiry, there is a provision of giving and taking physical delivery of product. That is also possible. Okay. So overall, allowed by regulator, we have 91 commodities on which we could have derivatives. But as of now, only 13 commodities as underlying on which we have derivatives on MCX. 90% exchange in India, largest exchange in India and seventh largest in the world. But out of 91, we have only 13 commodities as underlying. So that tells you we have a long way to grow. So that is when we say commodity derivative segment is second largest in the world, but in India we are fourth. Largest is equities. So in coming 2 decades from now, you will see commodity will gain traction, and we will also become second largest asset class in India when all these asset segments will be there, and when markets will be robust, developed in terms of products, in terms of participants, and when global participation will be coming, when FIIs and banks will be allowed, this market will see a huge upsurge. Now, why will see an upsurge as better than equities? Because equities only shares are listed in Indian exchanges, local company shares are there, but commodities which are listed are global products. So gold 24 carats, if traded in MCX, it is also traded in all exchanges in the world. So that is how the concept is. So what we have right now, black color is futures contract. So Boolean side, we have 4 kinds of gold futures, 1 gold option, 3 kinds of silver futures, 2 gold options. In energy side, we have crude oil futures, crude oil options, natural gas futures, natural gas options. And for your information, we recently launched natural gas options. 17th August 2022, we launched natural gas options. Base metals, we have aluminum, copper, lead, nickel, zinc futures, and options on copper, nickel, and zinc. In agri side, we don't have options right now. We have only futures in cotton, CPO, kapas, menthol, and rubber. And we have index derivatives. We have a Boolean index representing gold and silver. We have a Boolean index futures. We have a metal index representing 5 base metals, and we have a metal index futures. We have a energy index representing crude oil and natural gas, and we have energy index futures. So pending is agri index and its futures, then options to be introduced, then overall commodity markets index will come in, and then we have 91 commodities on which we could have derivative. So this market has a lot of potential to grow. Now, since commodity is a global product, there are many factors which impact the prices. This is what I've already talked about, orally when I was talking initially. So international prices of commodities, if they move, then domestic prices in physical as well as exchange market will also move. Impact changes in forex market will have an immediate impact on the commodity prices. Geopolitical factors, situations in global and economic scenario, Indian scenario, trade wars, war-like situations, like these pandemics and other situations will have an impact on worldwide commodity prices. Trade policies, barriers, regulation, taxation, quotas lifted, imposed, will have an impact. Economic conditions like recessionary phase, inflationary, this is what we have already talked about, have an impact. Economies, developed economies will have a different demand requirement and supply for commodities as compared to developing and emerging economies, which are major users of products. Plus commodities, any factor which impact the demand and supply of commodity will impact the prices, inventory levels. If we talk about agri product, weather variations, even say if cotton pink bollworm affects the cotton produce, it has have a bigger repercussion for in terms of availability of product in the market. Floods, destroying of products, like these many factors are there. So because of this, people who deal in physical markets, they face a challenge of either prices going or down. So for a farmer, prices going up is good. But for a processor, prices going up is bad because he will need to buy raw material. And if prices goes up, his raw material buying price goes up, but he cannot change the sales price. So in a commodity value chain, if prices goes up, it is good for some, but bad for few. If prices goes down, is also good for some and bad for few. For a farmer, prices going down is bad. For people, they say, for example, a jeweler or a cloth manufacturer, who is already bought the product and he's preparing the product to be sold in the market. If prices goes down, he will have a lesser realization. So in this market wherein people they deal with physical products, so it is a challenge for them to face the volatility in the product prices. So to face this, there is an easy way out. We have commodity derivatives through which people dealing in physical markets can hedge, do risk management. So who does that risk management? These people are called as hedgers. They are like corporates dealing in products, and 92 to 93% of the corporate sectors of the world, they deal in product and they do hedging to mitigate or to be protected against price variability of products. Corporate, farmers, producers, consumers, importers, exporters, merchandisers, people in the spot market, logistics companies, shipping companies, they all do hedging, right? So what is hedging? Hedging is a mitigation activity just to offset risk in one market by using derivatives gain in the other market. It is not a process by which your intention is to make money. To always hedge, you take positions in derivatives market which opposite to physical market with an intention to lock in the prices or offset the loss in one market with gain in the other. So in a way, it is an activity of transferring the risk to the market participants. And in a market, who takes the risk? People who have nothing to do with commodities, like speculators, arbitragers, traders, fundamental traders. They come to the market to make money. For them, gold prices going up or down, cotton prices are going up and down is not relevant because they don't have a physical product. For them, the direction of prices is important because they want to take risk and make money. So both the hedgers as well as traders are very important for the market because hedgers bring liquidity to the market, whereby traders bring liquidity to the market, so that if hedgers wants to hedge, he gets adequate ready participant on the other side to transfer the risk. So that is where this is how market works. Now talk about a value chain. What is a value chain? It includes anyone starting from the inception of the product till the end consumer.
If I take gold as a product, its value chain will include mining companies, refining companies, international banks dealing in gold, international companies, importing banks, exporting banks, bullion wholesalers, refiners, recyclers of gold, branded jewelers, unbranded jewelers, wholesalers, semi-wholesalers, retailers, consumers. So now everybody in this value chain dealing with gold as a product, with gold prices so volatile, will have some risk. And to manage these kinds of risks, people use derivatives. Now, for example, if I talk about a cotton value chain, we have who will be the stakeholders here in a value chain? It could start from a farmer to cooperatives, government agencies, buying and selling products, importers and exporters, ginning units, yarn manufacturers, textile units, garments units. So, these all people, they deal with the physical product. So price variability in cotton will impact their profitability at the end in case if they don't manage this risk. So for understanding, I'm just giving 2-3 situations, just in front of you. Situation one, there is a junior, is holding cotton stock, but wishes to lock in the prices of his stock now for a sales after 3 months. But what would be the prices after 3 months? Nobody knows. So how will he get a protection against this price risk? Now to do this, what is his risk? His risk is, what if prices fall? And how to manage that risk? He cannot sell everything right now because he'll be selling in 3 months from now. So he can use derivatives. He can sell derivatives right now so that whenever he's able to sell his product, he will be able to make some gain, which will offset the loss in physical market. Right? He could use derivatives effectively. Second situation would be, maybe an exporter in cotton receives an order today to export 5,000 bales of cotton by, maybe it is December, or maybe if you just today we are in February, maybe say in June 2022. He plans to buy a stock from the spot market to export. What is his risk? His risk is that he has taken the export order, but he will buy product in the market. What if in next 2-3 months cotton prices goes up? He cannot change his sales price. But if cotton prices goes up, it will hit his operating margins. In that deal, he would have added some operating margins depending on today's value of the availability of cotton in the market. But he will buy over a 3 month period and maybe a 2 month period and then export. So he also has a risk of prices going up. Maybe the third situation could be, a farmer wants to lock into the selling price now. His crop will be harvested in October, and he knows that would be a harvesting season for cotton, and market will be flooded with excess supply of cotton. So at those time prices will be less. So how can he manage that risk of prices going down? Again, using derivatives, all these intentions could be met. So typically we have two kinds of hedges using futures. One is a long hedge and the other is a short hedge. Long hedge is done when the intention is the price is going up can hit my profitability. Okay. Cash market is physical market. Maybe in cash market, people sometimes, physical market companies, they have received sales order in which the selling price is fixed. Example, for that exporter, his selling price is fixed. But to fulfill that order over a period of 1 year, he has to every month deliver some quantity of product. And to deliver some quantity of product, he will have to buy raw material, process, and then deliver. But when he entered into the contract today, raw material was at some price. But over the year, month on month, when he buys raw material, the prices would have changed. So he feels a risk when prices of raw material goes up because he cannot change his selling price. And if prices goes, he has to buy the raw material, make the product and give. So increasing raw material prices will eat away his operating margin. So what he should do, since derivative markets is simultaneously available. So moment today he got the sales order with the same quantity of product which he would require for a year, he should take a buy futures contract. So moment, month on month, whatever quantity of product he buys from the market as raw material, he will with the same quantity square off the derivative position, so that in case if the prices would have gone up in physical market, those prices gets covered by gain in the derivative. So intention is not to make profit, that is offset the loss in one market by gain in the other. That is the intention of hedging. The other kind of hedge could be short hedge. Who does a short hedge? A farmer, a person who has already produced something or is producing something. He feels the
commodity devaluation might hit him. What is devaluation? Prices of the products going down. So for this risk, in the cash market, he already has the raw material. Farmer has already sown the product. Maybe the jeweler has already bought the gold and had made the jewelry. Now these people are waiting for their sales to happen and realize the money. So they feel that whenever they are able to sell the product, at that time prices in the markets have gone down and they will realize less. So they have a risk of prices going down. So what they do is today only when they've started the production process or they've already bought the raw material or they are ready with the finished good, they could sell derivatives, sell futures on the exchange. And as and when with the quantity of sales they are able to do on the same day, they have to square off the derivative contract. So in case any less realization from today's price, if they will receive in physical market, they get compensated by gains in the derivative market. Again, the intention is not to go for profit making, but to for offsetting of loss in market by gain in the other. So this is how, hedging activity is done by all physical corporate users of physical products across the globe using exchange traded derivatives. So hedging helps in locking in the prices, being with your operating margins, having a better cash flow and inventory management, protection against price variability. And towards the end, if you are hedged properly, starting of the year, you have a proper hedging mechanism. So you don't worry about the price risk hitting you. You just have to focus on your core business activities. Who does it? Everyone. Now, the concept is when you trade in these derivatives, there is something called as settlement of derivatives which happens. Now this is called as daily settlement and final settlement. Daily settlement is when when you trade in derivatives, so there is a cost involved in trading in derivatives. That is, you have to pay margin money which gets paid back once you square off or close your position. But if I say live market, 10 million people are connected, they would be trading in their own different ways. So for every trade, margin has to be blocked, unblocked. So who takes care of this monitoring activity? That is done through clearing corporation of the exchanges. So even MCX has a clearing corporation who takes care of this activity of monitoring so that no manipulation happens. Everything is going as per defined by the regulator and the exchange bylaws and rules. One is that. Second is on a daily and real-time basis. If suppose somebody would have bought a derivative contract, how sooner can he exit on the exchange? Very next moment he can square off his position. So example, somebody has bought a contract at 100 rupees and after 10 minutes, he closes it at a price of 105. He made a profit of 5. On an exchange, it is a zero sum game. It means if somebody would have made profit, somebody would have made loss as well. Okay. So the loss on daily basis or profits on daily basis are settled on T+1 scenario. That is, whatever trades have happened today, its profit and loss get settled tomorrow, next day. So people who have closed their positions get their profit credited tomorrow, loss debited tomorrow. Plus, people using derivatives don't usually close their positions. All of them don't close their positions on the same day. They have taken an open position. They will keep it open for a duration of time, over a period of time. So every day at the end of closing hour in the night, there is an activity done called as marked to market. What is this M2M? It is again a daily settlement process wherein open positions are marked with the closing price of the contracts in which open positions are there. That means as compared to the open positions, all positions are marked, and in case in open positions you make money, you get something called as mark to market gain, and there is a M2M payout from the exchange in your account as a profit next day. And in case in M2M you are in loss, it is called as M2M loss, and M2M pay in gets triggered next morning. So people who make loss pays money as M2M loss for open positions, and people who makes M2M gain receives money with open positions. So this happens daily basis till the time the derivative contract is open. Okay. Now derivative contracts, all of them, they have a expiry date. That is called as a final settlement date. So on the expiry of a contract, there could be either two ways of settlement, either in cash, that is called as cash settlement, or settlement through delivery. On MCX and most exchanges in the world, largely derivatives get settled through delivery. On MCX, crude oil and natural gas are the only two derivatives which get settled in cash. What is settlement in cash in final settlement? That whatever has been your purchase price and the final settlement price, if there is a positive difference, you get money credited as profit in cash. And if it is a loss, you pay money to the exchange, get debited from your account. This is called as cash settlement. Apart from these two, whatever derivatives I've shown you, on MCX, they're all delivered on expiry. That means if as a trader, as a buyer or a seller, you have a position which remains open till expiry on the last day, last minute of the contract. So all open positions are randomly marked for delivery on expiry. So as a buyer, if delivery is marked to you, you have your open position. So you are supposed to take that delivery ownership in your name for the product as per the quality specification defined in the contract. So you have to take the delivery and pay full money to the exchange, right? Up till now in derivative prior to expiry, you are just paying a margin money, which is a percentage of the total contract value. But on expiry, once delivery is marked, you need to pay full money for that product, and that product ownership gets transferred to your name. You can take out the product from the warehouse, or you want to keep, then you pay, continue to pay storage charges. Same is with the seller. If seller has an open position, if he is marked for delivery, he has to deliver product to the exchange as per the quality standard mentioned in the contract. Okay. Now, people, if they don't want to take delivery on towards the end, what they can do is before expiry, they can square off their positions and roll over to the next contract, right? This is how products are settled on the exchange. Now, let me just go ahead. Along with futures, in futures, what happens? Both buyer and seller pay margin for open positions, and once their positions are closed, the margin money gets credited back. What is the option? Option is a non-linear derivatives wherein buyer pays premium. Okay, there are two options: call option and a put option. Call option is right to buy, put option is right to sell. Buyer pays premium, seller receives premium, and seller has to pay margin money. So margining happens on seller because seller is obligated, whereas buyer pays the premium because they get the right to buy or sell. Okay, so in commodities, commodity options in India, it is very different from currency, equity, and other options. What the difference is, the underlying is not the physical product, underlying is another derivative. So if I say I am dealing in a crude oil option, the underlying would be crude oil futures. If I talk about gold option, underlying is its gold futures. So with options, a lot of trading and hedging strategies could be possible for mitigating the risk and tradability, right? Plus, when we are in options, we can enter and exit many times. In an exchange like MCX, we have European options. That means buyer can execute his right to buy or sell only on the expiry date, but they can enter and exit as many times in a contract till the expiry date. So on expiry, what happens we have understood on expiry of future, the either it is cash settled or delivered based. Now, on expiry of option, what happens on expiry? If you have open positions and your open positions comes into exercisable options, so they get devolved. Daily settlement is again T+1, but on expiry, if it is your exercisable options, they get devolved into underlying futures contract. So if it is a gold option on expiry, if it is exercisable open position, it gets converted into gold futures. And then what happens? It then gets settled as per the specification of a future contract. So this is how options on expiry, they get converted. So a call option, buyer of a call options get converted into buyer of put, buyer of a futures, buyer of a put gets converted into seller of selling of futures, selling of call gets converted into selling of futures, selling of put gets converted into buying of futures. So we have like this some of the option contracts in gold, silver mini, crude oil, natural gas, copper, zinc, nickel, right? Also, I've already talked about index as derivatives. So there are some very important points, do's and don'ts. Generally, we don't talk about this, but this is are important. So whosoever deals with derivative exchanges, maybe in any asset, maybe commodity, equity, currency, they have to remember that you have to deal only with the SEBI registered members. And if you don't deal with SEBI registered members, you deal with an unregistered member, they can run away with your money. Plus, one has to diligently give their KYC, updated KYC in terms of their email ID and mobile number. Because once you trade on the exchange, exchange sends you many alerts in terms of margins, in terms of trades which happens, done by you. So if your KYC is wrong, you will not be able to receive the right messages and alerts from the exchange. So this is something one has to ensure through brokers, that their KYC is registered with the exchange database. And once that registration happens, a unique client code is issued to all the clients. Now this becomes one person's identity on the exchange trades. So all the trades and the contract notes will have this UCC number by which the ownership of the contract could be identified. And once we trade on an exchange, there is a document which explains the rights and obligations for any trader, and the risk disclosure document. All exchanges, derivatives exchange, have these documents readily on their website. So a rational trader, before coming and strategizing on derivatives, should be at least going through these documents, risk disclosure and rights and obligations. This is a must. What we should not do is, we should not get carried away by calls like, people, brokers calling us and saying, sir, 50% assured return, 60% assured return. Now there is nothing called as an assured return in the derivative market. Now the simple base is, if there would be a 60 to 70% assured returns, people will not be calling you, rather they will be busy trading and making money. So don't fall prey for all these things, all these mails or phones coming your way. Plus, don't get carried away with rumors, hot tips, advertisements, hot tips for the day, buying and selling, uh, I would say, trades, views. The actual point of rational is, if you be in derivatives or commodity derivatives, you should understand the underlying product, nature of the derivative contracts, make strategies on your own, and then enter the market, rather than other people telling you. You should make your own understanding of the products and then trade. Then, when we deal in derivative, cash transactions are not allowed. Anybody asking and giving cash should be a wrong transaction. SEBI has strictly conveyed that anyone dealing in financial derivatives will have to either deal online or through checks. No other transaction is legal in terms of trading. Plus, very important, we should not keep a blank document signed with the broker or the member, because they could write a simple statement and they can use our money at their own will. So we have to take care that we should not sign a blank document and give it to our registered members. And very important, there is a trading system called as dabba trading. It is an illegal way of trading. This is a book trading system, which we say is an off-market transactions, wherein to avoid paying margins and taxation and charges to the government, people, they get enticed by dabba traders, so that they say that don't pay margins, don't bring in more money. We do a book trading system whereby we write your trades, and in case by the end of the day you are in money, we pay you profit. In case you are in loss, you pay money to us. So it is a way of attracting people, whereby the rule of market is, if somebody makes profit, the other makes loss. So generally we Indians, rather than paying margin and taxes, let us just avoid them. And such people, they fall prey to these dabba traders. What is the attracting point is, they give you money, they give you profit, and only when they give you profit, it means dabba trader is making loss. So he will give profit for 10 days, so that you gain confidence and bring in more money. So once you bring in more money, what happens? One day double trader will make money and he will run away with your total capital. So this kind of a trading is illegal, and one should avoid. In case if somebody approaches us for doing this, we should ignore such kind of a trading system, which is not legible. Exchange and regulator is very tight on looking at who is doing dabba trading, and enormous fine is levied once discovered, and even provision of imprisonment is also there. So this is where, I want to end my session, wherein I would like to say that there, once you understand commodity derivatives, a lot of job opportunities and career-wise movement is seen from any corporate side, importers, exporters, bank,
hedge funds, not only in India, across the globe. You have commodities, you can work with exchanges, you can work with clearing houses, broking houses, you can be a analyst, you can fundamental analyst, strategist, you work opportunities to work with mutual funds and bank subsidiaries in commodity side opens up. We can work individually as a strategist in commodities and help small and medium scale enterprises who don't have their treasury desk to manage risk on international or domestic stock commodity exchanges. We can work with quality exchange agencies. We can get associated with government associations dealing in physical products. We can, as a research scholars, also do a lot of research on commodity side of many practical issues and submit our research to the competent authorities and get some recognition out of it. So that is also possible. Even government agencies dealing in physical products so from time and again they also come up with many job opportunities and career opportunities and consultation of job activities wherein we could fit in. Plus, very important point here is the second last in the right. This ecosystem is not a local Indian ecosystem. It is a global ecosystem. So in case you happen to move abroad, you have commodity exchanges, commodity linked companies, and all these activities happening in all parts of the world. These warehouses, quality exchanges, everywhere. So if you understand these markets using derivatives, so there is no fallback. You have many opportunities with markets developing. So a lot of information is available on MCX website. We have newsletters, manuals, printed materials. We have videos on different concepts. Even you can download MCX app and follow commodity prices and see the markets, how they are behaving with physical side and be updated on different things happening. This is where I like to stop my presentation and we'll take any queries very quickly you have. I hope I've added some value addition in your current knowledge base. That was the intention and intent. So we open for any Q&A. Please go ahead.
Any questions from the participant side? So they are actually, what happened, they have been enlightened with a little bit of knowledge over agriculture finance course. And I have touched a little bit of was about a stock exchange and some sort of commodity aspects. So some are interested, but what happened, sometimes due to its complexity, they may not be in the position to understand. But in due courses, they will be in touch with you, sir.
No problem, sir. We can maybe going ahead, we can do maybe this was an introductory kind of a thing. On a whole, we can have maybe specialized topic talks, maybe on settlement, maybe on risk management, maybe on different, we can pick up some different topics in detail and can maybe have a 1 hour discussion kind of a thing. So intention was to just introduce this kind of a phase of market to every one of us and maybe generate some interest so that we can discuss further as well.
Yeah. But we will make use of your inputs, sir. So in this onset, we will thank Sir Vinitji for your wonderful presentation. And at least nowadays, these times, the students may have been a little bit of knowledge about the commodity derivatives, what actually is and where we can apply the technical knowledge and we can develop in future also, because now at undergraduate level they need some foundation work, and I hope this will be a foundation for them. And thanking you for your much valued and prestigious presentation, sir. So
sir, all thanks to you for having me here, sir. Thank you for having me here. We will get associated more in future. Thank you. It was an amazing talking to all of you. Thanks to the management giving the approval for such an event. David G, Dobriel G, and everyone in the management. Thanks a lot. And sir, the only requirement and request is please do share the attendance and feedback with me over mail.
Sure, sir.
Thanks
Now I would request our respected Director Education, Dr. Anil Kumar sir, to have his concluding remarks. Sir, please.
Thank you, Dr. David Bhaskar. Very good evening to everyone. Indeed, it is a nice presentation delivered by Mr. Vineet Singh Kaler. He nicely covered about the integrate mechanism of operation of MCX, beside what do's and don't do's. That is very, very important while you are trading any of the commodity. Indeed, this topic is so complex, as Dr. David already told, that initial it was around 100 people, 100 participants, and now almost 50% still they found attraction in this particular topic. So it shows that people are interested to learn more about this multi-commodity exchange of India Limited. It is the first listed exchange. It is a state-of-art commodity derivative exchange that facilitate online trading of commodity derivative transaction, thereby providing a platform for price discovery and risk management. The exchange, which started operation in November 2003, operate under the regulatory framework of Securities and Exchange of Board of India, SEBI. And I'm sure that many of the students, even faculty, they are understanding that SEBI is the regulatory body which are not only controlling the stock market, but simultaneously all these NCDX as well as the MCX, they are under the regulation of the SEBI. And while you are interested to trade through MCX, then it is very much essential that you have to open a demat account, because this online demat account is essential not only for MCX, but simultaneously also for this commodity purposes. You have to do this on opening of the online demat account, and SEBI will allow only the trading through broking house. And I think retail investor, they are not allowed till 2017. But I don't know what is the situation now, whether the retail investor can also try to trade on this MCX or not. Now,
Allowed, sir.
They are allowed now. So this is before 2017, I think it was not allowed. It is only through broking house. And now
today also,
as,
sir, only through broking house they are allowed, but in different variables and products.
Okay, because I know little bit about the stock market, but certainly not MCX. But definitely, if you see that you have already told about this MCX, how trading could be done, how you can have like initial margin or market to market margin or special margin that are often used in this commodity trading. So correct, in a nutshell, I would like to say that that anybody who's interested to trade in commodity, then it is different from the stock market in one thing. Here buying is in physical form. But in the stock market, you are investing the money in the company, and company later on, whether they are going in profit or loss, accordingly, your share will be increased or decreased. But here commodity, I think he already told you about the risk. When you are trying to buy any of the commodity, what is the locking period, when you have to later on provide this to another trader or seller, and accordingly you can earn the money by this way. Now I'm sure that many of the students or faculty, they are interested in this, because this is a kind of side business also, or full-fledged business. As you see that there is a lot of value chain that is involved in this trading business, and accordingly there are also profit of the margin are there, and they are also determining this profit of the margin, because there are a lot of people are involved in this value chain, whether it is a gold value chain, cotton value chain, or many other commodity. You will find the value chain, and accordingly student and faculty can understand that what are the real risk involved, and at what time risk is involved, and what is the way we can able to earn more money. And accordingly, I think this is a kind of a more kind of passion, and also the kind of the experiences which will really facilitate you to earn more and more from this MCX market. I'm sure that the delivery by Mr. Binay Singh Kaler will be definitely going to beneficial to not only our student, but also the faculty member. And I am sure that some of them who are involved in the stock market, they will also try to do this trading through NCDX as well as MCX market. And beside, many of the students, they can also be go in this site as a job or also as a kind of business plan in this MCX or NCDX market. So I'm really thankful to Mr. Kaler, who accepted our invitation. And in fact, he has said that you have to organize one program, investor awareness program. And he has given the time. And I'm sure that time has come when students have to not only see that how their learning is in graduate and postgraduate courses, simultaneously learning in the stock market and commodity market, how they will be beneficial, how they will be able to obtain the job, and how they will also create their own job in this particular MCX market. So thank you very much. And thank you, Dr. David Bhaskar, Dr. Manmohan Dovrial, for giving me this opportunity to give this concluding remark, because I myself found out of place. I'm not much aware about this complicated or integrated mechanism of MCX or maybe NCDX, but time will come that I will also try to learn. Thank you very much.
Thank you, sir.
Thank you again.
Thank you for your valuable remarks and comments. And as you have rightly pointed out, the way forward for this webinar. And sure, there will be some highlights which can be a key message or a take home for the remark of this webinar. So I think it's official time to present the vote of thanks. And I take myself the privilege to present this vote of thanks. First, I would like to thank our Honorable Vice Chancellor who have agreed to conduct this webinar on commodity derivatives, because as it is new to our students, but agricultural graduates and horticultural graduates, they need to also know the importance. Our Honorable Vice Chancellor vision is always in the mind of taking our institute to the institute of eminence. And whatever the program which he approves will be the foundation for such momentum. So I thankful our Honorable Vice Chancellor, sir, and I am thankful for our Director Education, Dr. Anil Kumar, sir, who has been involved in many initiative purpose, and he used to always extend his fullest way of support for encouraging such type of conducting any webinar as well as any training programs. I thank you once again, sir. And I am thankful to our Dean Agriculture, sir, who have given his grace, and he has been blessed us with our conduction of this webinar. And I am thankful to you, sir, once again. And we are all thankful for our Director Extension Education, sir, who has also graced this webinar. And I am thankful to our Professor Dr. Manmohan Singh Dovrial, sir, because who was a key person in getting the full framework of this organization. And I am thanking all the professors, assistant professors, faculties, and scientists who have been as a part of this webinar. And last, I am much thankful to all our lovable students who have been contributing their busiest life, because nowadays during this online, they are much busiest than the offline, because they have been continuously flooded with knowledge and they need to reshuffle it knowledge. But they are giving some, finding some space to get engaged. So that, but this MCX will be an add-on to them. So I am much thankful to all the students of College of Agriculture, College of Horticulture and Forestry. So I am thankful to all those who are indirectly involved in this successful conduction of this webinar. Thanking you, sir. And now I seek the permission for the chair to close this webinar. Sir, shall I close this, sir?
Yes, yes.
Okay, thank you all.
Yes.
Thank you, sir. Thank you, Vinitji.
Thank you all. Give us more opportunity for interaction.
Sure,
Bye.
sure. Yeah, sure.
Thank you.
We'll be in touch.
Thank you. Thanks, everyone. Bye-bye.
Thank you, Dr. Tanuj.
Thank you, sir.
Thank you, sir. Thank you to all the organizers.
Thank you.
Thank you very
Dr.
much for
Sanjeev, Dr.
organizing.
Shailendra. Okay, see you.
Okay.